Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on divergent growth trends in APAC amid global trade flux. We sincerely appreciate your taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Ping Chu, renowned global credit rating expert in Singapore. Mr. John Beirne, Principal Economist at Asian Development Bank, Philippines. Mr. Jeff NG, Head of Asia Macro Strategy, Asia Pacific at Sumitomo Mitsui Banking Corporation, Singapore. This session will be moderated by Rajani Sinha, Chief Economist at CareEdge Ratings. We will commence this session with a presentation by Kiran Kavala, Senior Director at CareEdge Global, and Dr. Annie Mahajan, Economist at CareEdge Global. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Kiran to make the presentation.
Thank you, Mamta, and a very warm welcome to today's webinar on Divergent Growth Trends in APAC amid Global Trade Flux. As the world enters an era of uncertainty, we see that APAC economies are finding themselves in an unfamiliar position, which is expected to shape the future. In this context, today's webinar aims at understanding global trade dynamics and its implications. What are the key credit risks and buffers within the region, and how is the credit outlook expected to shape up? To begin with, let's look at the environment that the APAC region finds itself in terms of evolving global trade dynamics. When we look at the first chart, which shows the world trade growth against economic policy uncertainty index, since 2006, world has witnessed quite a few disruptions: GFC, first US-China trade war, pandemic, supply chain challenges, and during each of those periods, there was a dip in trade growth. But the policy uncertainty was never as it is now. That makes it an uncharted territory for the global trade. Naturally, the economies that are more open to trade find themselves more vulnerable. I have to mention that trade openness has been an enabler of growth over the last few decades. So far, economies with high trade openness have benefited by exporting to large global markets. However, with rising uncertainty and protectionism, this very openness has now put these economies at crossroads, making them vulnerable to global trade fluctuations. In the chart, which shows the trade openness of countries in our portfolio, out of the 8 countries above a threshold of 100 on the trade openness index, 4 economies belong to the APAC region, which are depicted in the dark shade in the chart. While there are European economies as well which are highly trade open, they remain relatively cushioned from global shocks as they conduct nearly 2/3 of their trade within the EU. In contrast, the growth journey for APAC economies has been closely linked with their increasing participation in the global trade. So their position becomes particularly critical and could be challenged by rising protectionism and higher tariffs. Having said that, APAC region has been able to maintain its share of global trade, and it is expected to do so in the future also, despite the current challenges, as can be seen on the left chart. If we look at the evolution of APAC's position in the world economy, we see that it stands out as one of the world's most stable and consistent growth regions. It stands at a middle order, neither too saturated as high-income economies, or not too low, where it has to catch up with the high base. Further, with rising purchasing power and strong long-term drivers like demography, high-tech penetration, APAC has room to grow both consumption and income. Its combination of a growing middle class, solid infrastructure, and reliable institutions make it a very key part of the global supply and demand chain. However, the region is expected to witness some moderation in the future growth prospects, which can be seen on the right chart, largely driven by trade-related uncertainties. Further, a slowdown in China and the US markets is also expected to hold implications. Having seen the region as a whole, now I request Annie to take you through the factors impacting the individual economies.
Thank you, Kiran. As we realize that uncertainty continues to loom around global landscape and APAC economies are expected to face the impact, it would be important to see the key risks and buffers available to region. We know that there is a moderation expected in the growth performance for the region as a whole. However, the implications of the slowdown is not expected to be uniform. The expected growth is likely to be divergent, which is visible on the chart that looks at the historic growth performance of the APAC economies against their outlook in the medium term. We can see clearly that there are few economies, as seen on the right side of the graph, that are expected to see moderation in the future growth performance. Notably, these are the economies where trade has been an important lever of growth. On the other hand, we see economies that are marked in green, which are expected to sustain the economic momentum due to their domestic demand that is expected to place them in a better position to withstand the current uncertainties. As we have seen that trade is expected to define the future growth trajectories of many of these economies, it becomes important to see the dependencies of these economies on US and China, naturally, as they have been the biggest markets in the world and they continue to define the global trade. Here, the countries highlighted in the red are the ones which, as seen in the previous graph, are expected to see moderation in the growth. Now, these economies have built high trade surpluses with the US, and as a result, they have a relatively higher share of exports directed to US as a percentage of GDP. But now, this very dependence on the US is making these economies more exposed as the US has drifted towards trade protectionist policies. Further, many economies have higher dependencies on China as well. We know that China has been a key supplier of intermediate and capital goods for many of these economies. So, naturally, any slowdown or supply chain disruption can eventually impact the production lines across the region due to limited short term alternatives. Now, extending this trade story, one outcome of the high trade orientation of the economies that is discussed above is that they have been able to build high current account surpluses over the last few years, which can be seen on the x-axis of the graph that shows the average current account surplus of the economies over the last 10 years. But by its very nature, high trade surplus makes these economies more exposed to the vagaries of trade cycles. And therefore, if we look at the y-axis, which shows the current account volatility or the standard deviation of current account balance, we can see that most of these highly trade open economies lie in the highlighted red quadrant. This indicates high sensitivity of these economies, especially in this current uncertain trade environment. Now, having seen the growth and trade linkages, let us look at the recent currency movement that could also have a bearing on competitiveness, especially for the export-oriented ones. Here we can see on the left chart from the movement of dollar index, there has been a weakening of USD throughout the year and more so since the Liberation Day. And as a result, currencies of many of the APAC economies have appreciated. Now, in this current context, strengthening of currencies could pose risks to the external competitiveness, especially for the export-oriented ones, and amplify high trade-related pressures. Given the background, government would also require fiscal space to respond and offset the trade-related implications. Across the region, we can see that the availability of fiscal space and trajectory of debt is not expected to be uniform. We can see on the graph a broad comparison of the historic debt levels of these economies compared to their future levels. Here again, there are few economies, the ones that are highlighted in the red, that have a relatively unfavorable trajectory of debt. That is, for these economies, debt levels are expected to go up going forward. Now, in the scenario of adverse trade implications, this could leave lesser fiscal space for any expansion policies. Additionally, some of these economies face unfavorable fiscal outlook also due to low growth interest differentials. As we know, growth interest differential is an important indicator of debt sustainability metrics. A low growth interest differential, combined with high levels of primary deficit, could place constraint on economies' debt raising capabilities. We can see this phenomena clearly on this chart. Here, the highlighted four economies are expected to have lower growth interest differential along with higher primary deficits in the medium term. Now, this combination would mean that any fiscal expansion for the necessary expenditure commitments could pose risks to the debt sustainability of these economies. Another area that warrants caution for APAC region is the steady rise in the private debt levels, particularly the household debt. This chart shows the trend in the private debt levels, and within that, the composition of the household debt levels and how they have evolved since the global financial crisis. In many of these economies, while credit expansion has been an engine of growth, yet the rising household debt levels indicates that sector is becoming more leveraged. Adding to this, credit exposure to the real estate sector also remains high for few economies that are highlighted in the red. This means that there are risks to the financial stability of the region as well and could have wider credit implications. Now, having seen the vulnerabilities faced by region, let us look at the buffers within the region that could offer resilience in the midst of uncertainties. Firstly, APAC economies stand strong with healthy growth prospects and robust investment potential. Looking at the graph that shows the long-term positioning of the economies with respect to their placement of the future growth prospects that can be seen on the y-axis and the future investment potential as seen on the x-axis. Here we can see that many of the APAC economies, including India, Indonesia, Vietnam, etc., are placed on the top right quadrant. This means that these economies have the necessary ingredients for harnessing the long-term potential with better growth prospects and high investment. Secondly, the region is likely to continue to be an integral component in the global manufacturing system. Looking at the graph on the left, even excluding China, we can see that APAC economies hold a reasonably large share in global manufacturing, with many of these economies acting as key suppliers for electronics, machineries, semiconductors, and even other intermediate goods. Now, as we know that the impetus for the future growth will come from the high-tech exports. The graph on the right shows that highlights the high-tech exports for APAC economies. And interestingly, for many of these economies, they have evolved to high-tech production roles, which could give them a leverage in case of any reorientation of global supply chains. Another key buffer is the dominant presence of service sector in the region. We know that globally, while goods trade has witnessed moderation, service sector has been holding up the world trade momentum as seen on the left graph. Further, within the region as well, there are countries with high service sector composition that makes them better positioned to navigate the uncertainties. We know that globally, with goods trade has witnessed moderation, service sector is holding up. Now, many economies in the APAC region have a diversified service sector, with economies like Philippines and India being key suppliers of global professional services. While other economies also like Thailand, Malaysia, Japan, they have gained prominence in the hospitality sector as well that could also cushion against the adverse trade implications. APAC economies have some strong buffers in their external position as well. They have built strong trade surpluses. Now, this strong trade surpluses have allowed these economies to build sizable forex reserves, which is helping them to maintain comfortable import cover as well. Here we can see while Australia is placed where with its FX being low, but it still benefits from its ATC currency, that is the actively traded currency status. So the benefit of this FX position is also expected to cushion against any unfavorable capital movement. From a monetary policy perspective, there is ample space available for most of these economies. On the left side, we can see that headline inflation has moderated across APAC economies. That can be seen from the movement of dark blue color line from the dark blue to the teal color, which shows the moderation in the inflation levels. This setting has provided space for accommodative monetary policies for most of the central bankers, which can be seen from the right chart, where policy rates have also come down. Here, we believe that there is still some space available for most of these economies to recalibrate the policies, especially when the external position remains tight and fiscal space remains constrained. This brings us to the end of stating the risks and the buffers available to the region. Now, we would like to know what it means further from the credit perspective. So I would like to hand it over back to Kiran. Thank you.
Thank you, Annie. Let's now look at what it means to each of the economies in the region from a credit perspective. Before I do that, I'll try and explain this dashboard. In the first column, we have all the factors that we discussed so far, both vulnerabilities and buffers. The colors, the darker shade indicates higher credit risk and lighter shade, lower credit risk. One disclaimer, given the high level of uncertainty and the dynamic nature of the situation, we haven't given any weightages to the individual factors. Now let's look at few of the economies as an illustration. Starting with Singapore, which is the highest rated economy in the region. Large swaths of dark shade in the top half indicating high vulnerability due to trade. At the same time, consistent light shade in the bottom half indicating solid buffers. Though as a number, there are more factors indicating vulnerability compared to factors that provide buffers, we believe these buffers are sufficient. Now, looking at, let's say, Malaysia, South Korea, Thailand, Vietnam, which are more open in terms of trade, these have more vulnerabilities, but have varying degrees of buffers from South Korea, which has more buffers, to Vietnam, which has relatively less buffers available. In summary, we are using these indicators to help us monitor the developments in the region. So to conclude, APAC as a region finds itself in a highly uncertain environment. There are quite a few vulnerabilities, but at the same time, they do have varying level of buffers across the region. That brings us to the end of our presentation. And now over to you, Mamta.
Thank you, Kiran and Annie. Attendees are requested to key in their question, which we will take up after our panel discussion. Now, may I invite Rajani Sinha to take over the session, please? Rajni has nearly 2 decades of experience in the field of macroeconomic research. Before joining CareEdge Ratings, she was the chief economist and head of research at Knight Frank. She has also worked with top institutions such as Aditya Birla Group, Kotak Bank, and JM Morgan Stanley. Actively devoted to demystifying the financial world, she regularly writes opinion pieces for business dailies on varied economic issues and occasionally delivers lectures at educational institutions. She is an alumna of the Delhi School of Economics and Lady Shri Ram College. Over to you, Rajni.
Thank you, Mamta. And thank you, Kiran and Annie, for a very interesting presentation. Global economy is indeed going through turbulent times, and global trade, that was engine of global growth before the global financial crisis, I would say, that has slowed down in the last few years. And just to give some perspective, if we look at the kind of CAGR growth that we were seeing in global trade, including goods and services, this number has slowed down from around 9% pre GFC in the decade before the global financial crisis. This number has now slowed down to around 3% or so. And in fact, the situation has worsened in the last 1 year with the US reciprocal tariff scenario. And as we discussed in our presentation, many of the economies in the APAC region are quite open, and they benefited strongly in the past from the good global trade that we were seeing. And now it will be interesting to see what's going to be the implication of the slowdown in global trade into many of these economies. In fact, even some of the other economies, like say India, Indonesia, which are relatively less open, they are also going to feel the pinch of this high tariff. Moreover, like we discussed in the presentation, what we are also seeing is that China, which is a major player in the region, their growth is slowing down. And given that, many of these countries in the APAC region are quite interlinked to China, it would be important to see as to what's the implication of slowdown in China to these other economies. So we're going to discuss all this in our panel discussion. And we are very happy to have a set of very accomplished panelists with us. And let me just start by introducing the panelists. So we have Mr. Ping Chu. Um, yeah. Ping has extensive experience in the financial and credit rating sectors. He has held various senior level positions at S&P Global, including head of Greater China and CEO of S&P Ratings Services in Hong Kong and China. Additionally, he served as the Asia head of food and agribusiness research and advisory at Rabobank. Ping holds a BSc in econometrics from the London School of Economics and political science and an MBA from the National University of Singapore. So thank you very much, Ping, for joining us. Then we have with us Mr. John Beirne. John is currently Principal Economist at Asian Development Bank's Macroeconomics Research Division, specializing in international finance and macroeconomics. He has over 20 years of professional experience as an economist, including more than a decade in central banking. Before his current role, he was Vice Chair of Research and a Senior Fellow at the ADB Institute in Japan, where he co-headed the research department. John's research and policy work focuses on exchange rates, commodities, financial crisis, capital flow management, and monetary policy transmission. He has published widely in journals and is a frequent contributor to the media on global macro issues. He holds a PhD in economics from Brunel University, London. Thank you, John. We also have with us Mr. Jeff Eng. Jeff is head of Asia Macro Strategy in Global Markets and Treasury Department, Asia Pacific Division at SMBC. Jeff is responsible for formulating views on Asian macro with a focus on currency and rates market, issue trade recommendations, and deliver SMBC's Asia focus outlook to clients in the region. Jeff has extensive experience over 16 years in presenting his views on Asia in various parts of the world, including the US, Europe, and Asia. He is also a regular speaker in conferences, including various TXF Asia Conference from 2019 to 2022 and the Canon Think Big Leadership Business Series in 2019. He also regularly appears on local and international media, including CNBC and CNA. His specialty is in Asia, ASEAN, Singapore, and China. Jeff graduated from NUS with a bachelor's in social science and economics and obtained his master's degree from London School of Economics in Management and Strategy. So, thank you very much for joining us for this panel discussion. And I think I'll start with you, Ping. And, as we discussed in our presentation also, the kind of uncertainty that we are seeing in the world right now is much more than what we have seen in the previous financial crisis, be it the global financial crisis or even the Asian financial crisis or even during COVID. But if we look at the uncertainty index now, it's at a much higher level. So, what is it that you would say differentiates the current crisis from some of the crises that we've seen in the past?
Thanks, Rajani, and thank you for having me. It's a pleasure to this panel with distinguished guests. Let me start off with this. I lived through the Asian financial crisis. I lived through the global financial crisis. During those times, it was a precipitous fall in asset values. It was societies were damaged, lives were lost, and there were regime change. So I would respect to Kiran and CareEdge. I wouldn't lump current situation environment to those crises. During those times, from industries to economies to governments, they have taken improper practices. They were improper and inappropriate policies settings. There were poor regulatory and supervisory regime that created huge systemic financial balance sheet contagion as well as eventually destruction. And that is, I would say, a much larger than fallout from these events. But what you highlighted right now is correct, that uncertainty is a key word currently. There's a confluence of factors and developments that are sapping confidence and creating issues that economies have to address. Of course, the top of one mind is the U.S. current tariff regime, as well as the global trade disruption is creating. But these, I think, is more micro than macro in nature. And as you rightly pointed out, a lot of the Asian economies are resilient. There are no major monetary or fiscal exchange rate policy settings that are creating financial asset bubbles currently. And so I don't think we will see the kind of fallout from those crises. And the measures that I think many economies have to deal with, have to think about, are also less about macro policy settings, but they are more complex and challenging in the sense that it has to deal with more structural and industrial elements of each economy. I talked to some of the companies, that are faced with tariff adjustment right now. They have to deal with how to shift goods from one location to another in order to supply US or the rest of the world. They have to deal with logistic operations review. They have to deal with whole supply chain review, and even to future investment strategies. And what adds to this uncertainty is whether the current status will remain the same within a year, and much less so in 3 years or 5 years. And that doesn't add certainty, at the least, to companies with 10 years investment plans. And so what you have are companies stuck adjusting to the short term and thinking about the long term. And in this case, how does this will lead to future investment sluggishness? And this is where maybe governments and countries can help address. And this is not just by giving textbooks, but longer term review of its advantages and competitive nature in helping with production ecosystem, including infrastructure, including HR labor improvement, and even technology and digital transformation in order to support companies and industries position themselves for the future.
So, Pink, yeah, definitely. I mean, we are going through uncertain times, and many of these economies and companies operating in these economies will need a lot of support going forward. With that, I'll come to you, John. Before we talk more about the APAC region, if you could throw a little light on this whole problem is mainly because of the US reciprocal tariff. So, where really is this emanating from, the US reciprocal tariff? And going forward, what should we expect in terms of US trade policy? Because that's going to have implications for APAC region and other regions.
Yes, thank you very much for this question. I think, we had a major shock at the beginning of April with the announcement of these reciprocal tariffs, which of course were aimed at reducing the US trade deficit. Subsequently, there was a long pause announced in the tariffs, which has since been addressed in some cases. But I think, the impact of even during the pause has been quite significant. As alluded to by the previous speaker, there has been a significant increase in trade policy uncertainty during this period at historic high levels, going back to the start of when this type of data was being collected in the 1960s. So we saw a very rapid increase in trade policy uncertainty in the period from April. It has since come down somewhat, but remains very elevated. And this is really affecting long-term investment. It's, affecting sentiment both on the consumer and on the investment side. So when one looks at how to buffer against the negative impacts that this can have on the external side, the impacts are also negative on the domestic demand side, should it lead to reductions in investment and reductions in consumption. We have seen, as I mentioned, some agreements kicking in at the start of this month. There still remains uncertainty, as I said, in terms of how we see the trade situation evolving going ahead. Well, I think, tariffs have sort of leveled off at a lower level than was announced in April, but still high. Uncertainty remains high, and there will remain significant challenges for economies in order to overcome these new challenges. So I think there will be to a large degree, there will be reliance on domestic demand as a buffer, but also looking at the diversifying trade, diversifying investment over the longer term as a sort of a structural approach to addressing some of these concerns.
Jeff, coming to you now, like we discussed in our presentation, many of the economies in this region have very high trade exposure, high openness, say Vietnam, Thailand, South Korea. So, how do you see these economies coping with this trade shock? And what do you think are the strategies they are going to adopt going forward, given that, this uncertainty is likely to remain there for some time?
Yeah, thanks for having me for this seminar. I think it's really a huge challenge to these economies. You have mentioned Thailand, Vietnam, and South Korea. These economies are in varying stages of development at this stage, with South Korea being more developed, but still considered an emerging market. And Vietnam, I think, still in the early stages of development. So many of these industries, they are still relatively fragile at this stage. And to address some of the challenges that could be more persistent, may mean that they have to adapt quite rapidly, even despite the fact that they have not matured. So I would say that there could be more structural repositioning along the way. So perhaps more movements away from trade with the major economies, more diversification. I think we've noted that so far, while there's a lot of considerable volatility in the US and China, but many of the other Asia economies, I think the economic prospects, there's some mixed fortunes, but overall remains relatively bright. And I think many of these economies, they're also thinking about moving up the value chain as well. Examining ways to produce and export more sophisticated products. I think these are the trends that will likely take fruition in the coming years or so. For instance, for Vietnam's case, it could be to further develop the semiconductor industry. For South Korea, I would imagine that they will have to find more trade partners. Thinking about those other economies that have traditionally worked very closely with South Korea in the past. For Thailand's case, I think it has traditionally been a manufacturing hub for autos. So I think that may persist, but also trying to pivot away closer towards EVs or other products in order to diversify away from the risks that we are currently facing. So I think all this, I think, necessitate need for more infrastructure spending to support this economic growth. And I think that could mean that in this environment where there's a lot of uncertainty and with some potentially domestic challenges as well, it could still remain fairly challenging.
So, Jeff, one of the things you mentioned was diversification to, more advanced products to other markets. And that's something which China has been doing pretty well. And they actually got a taste of the trade war last time in the Trump period. So they have already experienced that. And we have seen that China actually increased their trade surplus with other trading partners, even while their surplus with US has reduced. So, Being with that, I'll come to you. How well do you think China is prepared this time? Because this time in this trade war, the additional problem that China has is that it has its own domestic issues that they are going through. They have sluggish demand. They have their own, high unemployment, low consumption problem. So how well are they prepared to handle this trade shock?
Before I go specifically on China, just a quick comment on the export economies in Asia. Many of them have benefited in the recent years from robust, still pretty robust U.S. growth, global growth, and slowing but still ongoing globalization and trade. But some of them actually have benefited from this phenomenon of diversification from China and setting up production base in some of these economies, especially Vietnam, in order to support or export to US. And especially if US now looking at some of these economies more directly and specifically, these are what they used to rely on, these Chinese investments into the economies in order to circumvent the first trade, the Trump trade tariff on China. So they have a lot to think about. But again, it's something that is very different from what they faced in the Asian crisis or for the global financial crisis in terms of macro policy set. On China itself, first of all, China has indeed thought of export diversification for some time now. Example, through the Belt and Road Initiative. And they have also their companies also have moved into new production base, like I mentioned, Vietnam. But this is coming to a reckoning because the US is not being fooled by this the Chinese exports coming out from Vietnam as Vietnam export. So what is happening in the near term for China's economy could be a double whammy. First form is, like you said, is domestic sluggishness, as well as what these reduced exports will do. But China's future export really still remains driven from its domestic conditions. Just a very interesting fact. When almost every major economy in recent years have been plagued and still only recently reduced pressure by inflationary, China inflation actually has been very subdued, probably less than 1% since early 2023, and even negative sometimes in 2025. And that's due to weak consumer sentiment, poor employment and income growth, of course, the real estate sector collapses, and also the overinvestment and excess production capacity. The latter, i.e. the excess production capacity, will face even more pressure when these exports are diverted back domestically. And let's talk about overinvestment and excess capacity. This is the latest hot word in China is involution. Many have heard about this. And the latest one is on EV, is on solar panel. But overinvestment and excess capacity has been happening in China over many decades. In the early 90s, after liberalization, light manufacturing, textiles eventually became the state of overcapacity. In the late 2000 to 2010, it was infrastructure, it was real estate, it was construction. I think everyone heard of the road to nowhere. And now it's falling into EV and solar. And all these recurring issues have common structural factors. Everyone knows about that. One, state-directed investment, local government competition, giving out incentives and subsidies, and the high investment rate and low consumption, high savings rate and low consumption in China that leads to all these financial repression with the banking system and eventually overinvestment. And so what you're seeing now in EV and what's talking about in EV and solar has been happening. In the past, China has been able to navigate through these issues with huge liquidity. It has huge savings and very strong government assertiveness. But increasingly, it will be more and more challenging for the Chinese government. Over so many past cycles, the government has been loaded with more debt onto the government balance sheet. And these are through local governments, from the financial sector backed debts, or even through direct fiscal support. And so it will be interesting and even challenging for the Chinese government to see through the current crisis or current situation and environment and position itself, even as it tries to address its external challenges.
With that, if I look at the other big player in the region, India. So, John, my next question is to you. India has relatively lower trade openness in terms of exposure to US, trade exposure to US is less, but they have been imposed very high tariff rates. The government has announced some measures and is thinking of more measures to support domestic demand. But overall, how do you think India as an economy will be able to cope with this shock?
Yes, thanks for this question. As you said, as you rightly said, the direct exposure of India to the US is more limited. So the impacts of these tariffs will be somewhat less than they would be in other economies that would have stronger trade exposure with the US. So I think this is one thing to take into consideration. But I think it's also important to recognize that there will clearly be some impact, some negative impact of these tariffs on the economy, and particular economies in India will be disproportionately affected, particularly those economies, those sectors that are involved in exporting to the US. So textiles, apparel, for example, would be key sectors that would be affected. The question is whether domestic demand can offset some of these external pressures, let's say. And I think that it's really a question of duration. There can be some short term or even at the medium term level, some buffering effect by domestic consumption. Domestic investment can also be a factor which can help to sustain growth during this period of high uncertainty. But I think that over the longer term, this is not something that's going to be sustainable. I think it would be important to use this opportunity actually to engage more deeply in global value chains, and this can help to diversify the economy further, and in this way it could make the economy even more resilient to external shocks in the future. So I think that even though the economy is not as exposed to trade directly with the US, as I said, there will be impacts due to the tariffs that have been imposed, the uncertainty around the tariffs that have been imposed. Domestic demand will be an important buffer, but I think over the longer term, the goal should be to engage further in global value chains to make the economy more productive, and also to make the economy more resilient to external shocks such as these going forward. And this can include things like further development in FDI, for example, and engaging more in terms of global trade integration. I think this can be something that can be taken out of the current episode.
Absolutely, John. So it will be actually important to see as to how the Indian government uses this opportunity to push for further reforms. So let's see what happens on that front. There are a lot of kind of plans in the pipeline. There is expectation of some GST reforms also. We'll have to see the impact of that on overall on the economy. It's expected to give some boost to domestic demand. Uh, Jeff, with that, I'll come to you. What about the some of the other economies in the region, say Indonesia, Philippines, which are relatively, which have relatively less trade exposure? How do you think they are placed? They will get impacted by this trade shock, but how well are they positioned to take care of the shock?
Now, I think for these economies, I don't think they are totally spared because the uncertainties, despite the sort of more limited trade openness, this may impact on the domestic outlook as well. I think both the domestic and the external outlook will be integral for these economies. But I think the positive part is that they continue to have a stable and a positive domestic engines that can provide some resilience, although we are concerned about, say, the potential impact based on the indirect impacts from uncertainty. I think those for Philippines and Indonesia in particular, they do have some positivity from, let's say, being resource oriented or being sort of like services oriented. Philippines, for example, they rely a lot on remittances inflows, which may cushion against any trade volatility, and at the same time, their BPO industry is also one of the sort of like most important in the world alongside India. So I think these factors, the reliance on services, the domestic centeredness can help to cushion any of this volatility. But if these headwinds cause the indirect impact to be posed and sort of accelerate and amplify the impact from those uncertainties brought about by tariff, I think there could be more risk ahead. So I think overall, what we will think is that to cushion any of these risks, I think more strengthening of domestic resilience against any of this, which includes I think strengthening incomes for domestic consumption, infrastructure projects to continue to improve on the depth and quality of growth. I think this could be potentially important to help to cushion against further sort of like volatility and uncertainty in the trade-related space.
Apart from this US tariff related concerns, John, the other issue I want to discuss is China. And if you know China, if there's a slowdown happening there, a lot of countries in the APAC region are quite interlinked with China. So this is going to have implications on some of the other countries also in the region. So how do you see this playing out going forward?
Well, certainly, the importance of China for the region and its weight in the global economy would be a concern should the Chinese economy slow down. As you said, many economies are highly interconnected with China, and this has been increasing over the past decade. So clearly, a slowdown in China would have a knock-on effect in other economies. But that said, if we look at many of the economies, for example, in Southeast Asia, where there are strong investment ties with China, many of these economies have diversified significantly in their own right over the past decade as well. So this makes them less directly vulnerable to what might happen in one particular economy. And also, let's also bear in mind the space that these economies have in terms of monetary policy space. So inflation has something that has come down significantly over the past year or so. And this provides central banks in the region with space to reduce rates. We have seen this taking place already this year, and this is something which will help to support domestic demand in the interim. And there is also fiscal policy space in many economies, which can also help to sustain domestic demand during this period of potential transition. And I think, yeah, so as well as supporting domestic demand, I think economies can further diversify, and this can help to weather some disturbances that could come from a slowdown in China.
So, yes, definitely. You spoke about the scope of further monetary policy support, and you also spoke about fiscal support. Pink, how do you see the region? Some of the economies, the debt is rising, the government debt. So, how much of scope do they have for providing fiscal stimulus?
The other panelists have also rightly pointed out there are some room, but this depends from economy to economies. I think some of the higher indebted economies and some of the major ones like China and India, they are actually have pretty high debt levels, and this has been built up over years. And so in terms of how they can afford to pump prime, how they can afford to cushion the slowdown, how they can afford to spend on longer term, we have to think about the debt capacity, but also the effectiveness and efficiency level. We have a next tier of economies, those even include like Malaysia or Thailand, or Philippines or Indonesia. I just want to remind everyone that Asian economies, except for China, it's maybe as a very clear example, many economies don't really use fiscal very extensively to like the way China does. In 2008, China really pumped prime and not just supported itself, but actually supported Asia and quite a bit of the global economies. But the rest of the region, especially in Southeast Asia, don't have that experience and ability to use fiscal spending, government spending, budgetary spending to build effective, not just short-term cushion. Short-term cushion is easier, but medium-term areas in order to support the economy. During COVID is a different thing. During COVID, you have stimulus spending, you have a support disruption across the whole society. But right now, you're seeing things, an environment where you have to think, like I mentioned from the very beginning, you have to think about longer term competitiveness. You have to think about, like John said, its place in the value chain. And so this requires a more targeted structural, industrial, and education policies, for example, to increase productive capacity, to improve the investment environment, to build educated and skilled workforce. And so how the fiscal policies, the industrial policies, complementary industrial policies come into effect, and that I think each government has to review that. There are some rooms, but I wouldn't say that there are a lot of places just for direct pump prime.
With that, we'll move to the last question. And Jeff, that will be for you. I would like to get your perspective on uh, what would be going forward, what's going to be the FDI picture for this region, for the APAC region as a whole, what should we expect? Secondly, this whole China plus one that we've been talking about for so long, which of the countries in this region are better prepared to take up that China plus one opportunity?
Okay, thanks for these questions. Well, in terms of FDI attractiveness, I think this year I wouldn't say that they have changed much from previous years. I would say that some of the economies that continue to have strong fundamentals, positive ratings, like Singapore, I think they continue to attract a lion's share. For us at SMBC, we track the Japan investments, outward investments to the region. And I think Singapore continues to take a lion's share last year. And I think we will continue to expect that this year, even with all the tariff-related factors, due to the fact that tariffs may change every week or every month. But I think fundamentals may not change that much. At the same time, I think what we see is that there will be, in a very competitive landscape, other economies that could benefit as well. I think India will also benefit from China plus one. And I think many of the Southeast Asia economies like Malaysia this year, I think the outlook is looking fairly positive. Vietnam continues to be fairly bright despite the tariff. I think it's looking quite bright. With regards to the China plus one kind of strategy, I mean, I've been around speaking to clients around the region. I think when tariff rates may be changed very frequently, and right now I think manufacturers are also thinking that the tariff rates may be anchored at a fairly moderate level, around 20 or 10% for the bare minimum towards 30%. I think on average around 20-25%. It means that the sort of like risks are firming up. There's more certainty now, and then they will continue to look at the medium term favorites. I think Vietnam, for example, they have benefited over the past 10 years, may continue to do so. India, I think the outlook has been quite positive over the past few years, and that may persist as well, alongside other places in the Southeast Asia, as I mentioned. So yeah, that's a sort of like appropriate answer. Thanks.
Yeah. So overall, Jeff, global FDI has been going down with this uncertainty going around. So it will be interesting to see that which of the economies are able to push the reforms, improve the ease of doing business, and able to attract more investment going forward. With that, I will end this panel discussion. Thank you very much for your insights. And back to you, Mamta.
We will now take up a few questions from the audience.
Yeah, so I can see some questions. Just a minute.
Our viewers are please requested to key in their questions.
Okay, so I can already see some questions. So the first question is on India. What reforms are most urgent for India to boost its share of global FDI inflows, especially amidst rising competition from Southeast Asia? John, would you like to take that question?
Yeah, sure. I think this is a difficult question, of course. I think we've already touched upon some of the regulatory issues that could be helpful in terms of stimulating further FDI. But I think in terms of looking at comparative advantages within India and how to maximize upon them, clearly digital services is something that is very strong in India, and there can be further policies that could be implemented to enhance attraction of FDI into that particular sector, digital economy policies around data localization and other e-commerce regulations that can help to stimulate further inflows of FDI. I think sector-specific issues as well can be important in order to diversify further and to open the FDI market more broadly. So I think those issues around regulatory openness, let's say, focusing on policies that can improve the comparative advantage that India has, particularly in services, and other sector-specific issues as well, which can open the market further.
Okay. The next question.
Maybe I can add to that. I think if you look at how India can attract investment, I think there are two key aspects. One is whether in like Southeast Asia, a lot of FDI to build export capacity. That's one way. But India compared to Southeast Asia and China are not as reliant on exports to boost its growth. But that is also, on the other hand, a potential opportunity, especially countries or companies diversify away from China. The other thing is actually more important is India's domestic market. That's the huge potential that everyone's been talking about for years, for decades. If India can open up its domestic markets even more, I think a lot of the companies very quick to jump in.
Yeah, absolutely. The next question is, how will complex issues such as transshipment related tariffs be handled? And what impact will they have on China and other APAC economies? Ping, you want to take this? You spoke about a lot of exports happening from Vietnam.
I think this largely must understand whether the country imposing these tariffs, i.e. the US and its administration, understand what's going on the ground and wanting to address it. I think in certain ways, these the tariff that some of the tariff that the US have imposed addresses some of that. And so everyone will be a bit on their guard about this. Whether there will be more scrutiny about this remains to be seen. But at least for now, there is the tariff regime seems to be settled for a little while, and hopefully that will remain so that the companies and economies can then act upon it. But how again, I hasten to say I can predict what one man or one administration will do in the next few months or year.
The next question is, Jeff, you can take this question. Do you see any possibility of BRICS currency coming into the picture?
Well, I think we are moving to an era where things are more accessible, be it cryptocurrencies or other forms of payments. So I think with more accessibility, more tech development, I think the ease of getting more alternatives is improving. However, I think whether that can materialize, I think will also depend on the players that are inside BRICS Plus themselves and whether they want to move forward with that, because I'm sure many of these actors, they also have views that, for instance, they may want more of their own currency or maybe digital versions of their currency being used more frequently. So yeah, I would say that in this current environment, there will be potentially much more avenues for payments and transactions going forward. Thank you.
So I think I'll take the last question. With the holiday season sales for US just 3 months away, how much could be the impact of tariff on India's exports? Any secondary spillover effect, that would be significant? How much of a strain this would have on export-oriented credit system? John, would you like to take this?
Yes, sure. I think it's again, it's a difficult question to answer. I think there clearly will be strains due to these tariffs, but again, really reinforcing what we've been saying throughout this panel. It's really important to look at the longer term and how this opportunity, well, one can call it an opportunity, but how one can really build resilience from this episode. And I think, bolstering efforts on economic integration, reconfiguring supply chains to adapt to these new tariffs, seeking new trade agreements, for example, with other regions, other economies, is very important over the longer term. So I would just reinforce that point.
To that, John, I'll just add the near-term expectations that we have. Given that India's first quarter GDP growth number at 7.8% was much higher than expected, now for the full fiscal year, FY26, we are expecting growth at around 6.5% or so. But this is based on the expectation that this additional 25% tariff that was imposed by US will be taken back and we will be able to negotiate some kind of trade deal. But if that's not the case, if the 50% tariff stays, then in the near term for this fiscal year, we are expecting growth to move closer to around 6% or so. So that's how we are looking at the near-term growth outlook. I think with that, I will end the session because, yeah, we have reached the time. So Mamta, back to you.
Thank you, Rajni, for moderating the session, and Kiran and Annie for your presentation. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.